welcome to Sectors Up Close. I'm Elena Casas. Our topic today is US banking stocks, and my guest is Chris Marinac, Director of Research at Janney Montgomery Scott. Well, like the rest of the market, US banking stocks have had a rough year, as measured by the 18 lenders that make up the S&P 500 Banks Index. The sector is down about 20% in the year to Monday. That's slightly worse than the wider S&P 500. Last month, Wall Street's biggest banks reported falling profits as they braced for a weakening economy. Rising interest rates are bolstering income, but central banks' battle with inflation is widely expected to cause an economic slowdown. Just how severe is up for debate, but JP Morgan alone reported a 30% drop in profits as it set aside $800 million in loan loss reserves. Citi and Wells Fargo also increased provisions on expectations that America's checking accounts will soon start to run dry. So what's next for this sector? Let's ask Chris Marinac, Director of Research at Janney Montgomery Scott. Chris, hi, thanks for joining us. What did you make then of the bank results numbers we've seen for this quarter? Generally better, I know, than we were expecting, but still banks are clearly setting aside significant sums of money in anticipation of dark times ahead.
That is correct. The good news was the spread revenues improved as net interest margins widened as interest rates and the impact of the Federal Reserve was quite pronounced in the third quarter. The higher credit reserves are really a precaution against what is unknown in terms of losses and problems in 2023. We saw the actual amount of bank problems being very limited. In fact, in many cases, the level of criticized and classified loans actually fell from June to September. So the reality is that bank reserves are growing really to be careful, not because of any realized issue at the moment. But I think the darker clouds in 2023 are what has bothered investors here in recent months.
Let's talk about the Fed then. We expect another 75 basis point rise this week and potentially another in December. What impact is that likely to have on banks' balance sheets?
So banks are actually going to see spreads widen further because they will have loan yields reset with this week's Fed hike and presumably again at least 50 basis points more in December. The cost of deposits is rising, and we think the speed at which deposit costs rise will be much greater in fourth and first quarter than we saw in the second and third. However, I think net interest margins still have a ways to go. Many banks had a pretty big step up of margin in the third quarter. The pace of change will be a little slower, but still positive in the fourth quarter.
Given that then, do you think bank stocks have been oversold thus far this year?
I do, and I think the reality is that the concerns about a weak economy are a little overblown. We can stomach a lot of credit losses in this industry and still have profits stay restrained. That's the good news about the credit reserves as well as the earnings. The banks have better earnings today than they did in the fall and early spring of 2008 and 2009. Back in the great financial crisis, you had just really weak profitability and weak revenues. Today, the opposite exists. Profits are good, particularly with revenues improving. I know that some of the fee income lines for the JP Morgans and big national banks have struggled, but their core lending arms are doing quite well.
So you're pretty bullish, it sounds like, going into 2023. What's your outlook?
So my outlook is that there is a stronger revenue growth of the industry. We think revenues will outpace expenses next year, and that operating leverage will still be positive for the industry. We think the companies will see tangible book value growth improve after some rough quarters on book value because of security marks. I also think that share buybacks will continue in the industry and dividends will rise. So it's going to be a slower growth year, but I think it's going to be a better year than investors have priced at this juncture. And we think relative to where the S&P is trading, the banks are very much at a discount, and there's room for the banks to trade better on a relative multiple basis.
How do you think investors should be approaching the big US banks at the moment then? Are there any which seem particularly strong bets to you?
Well, the regionals like a Fifth Third FITB, which we have buy rated, I think is very well positioned for success. I think they had a better third quarter than the market interpreted. Certainly, you can look at other regional banks like the Regions Financials RF or Truist TFC. Those stocks have additional room for upside. We think their core businesses are quite good, and both of those are very heavily core funded companies. The core funding is really the critical piece for the banking industry right now. We think core funds are going to become more valuable as we go through this interest rate cycle.
Well, thanks so much for that, Chris Marinac, Director of Research at Janney Montgomery Scott. Well, that's our look at the US banking sector. I'm Elena Casas, and this is Reuters.